Today, before I get into the video, you might be asking yourself, who is this guy? Why should I listen to him? What makes him qualified to talk about this? And why is he not wearing a suit and a tie? You want to know why? Because I don't have to. I don't go to a job. I don't take orders from people. Now, I work with people, but I did it. There was a time to where every morning I put up a suit and a tie. And I work for corporate America about 7 years, up to 2011. And past that, I was a consultant. I started my career in 1999. And I've always invested on my spare time. Even when I had a day job, I was invested. And now, this is 2024. That's what I do full time. And I can help you accomplish what you set up to accomplish. Now, why are ETFs better than individual stocks? Now, what do I mean by better? I mean that it's a safer investment. It delivers a safer return, and from your side, you really don't have to do anything, because the broker that you buy the ETF from, they do all the work for you. So now you might want to be a stock picker. You want to be the next Warren Buffett. You pull up a price chart of a stock that went up in value, like Apple, Microsoft, Nvidia, and you think to yourself, oh, I should have bought Apple 10 years ago, or I should have bought Nvidia. That's what I'm gonna do. I'm gonna buy it now. It doesn't really work that way. Like it's been said that past results are not representative of future gain. So buying Apple today doesn't mean that you're gonna accomplish that type of return. When you look at the fundamentals of a company, like Apple again, and I'm talking about Apple because I imagine that most people are Apple fans and they're very familiar with the company. But the mere fact that Apple revenue has been growing year over year, that Apple profit has been growing year over year, the share buybacks program has been very successful. The dividend has been increasing. Does not mean that this is gonna keep going on and on and on forever. This is not a stairway to heaven. I'm talking about Apple, but I can talk the same way about all of the top 10 companies in the United States. The mere fact that those companies have been very good performers from a fundamental standpoint, and of course their stocks have been outperforming the market, does not mean that this is going to keep going forever. Nothing is forever. Do you have an objection on that? Now, what should you do? Should I buy individual stocks? Or should you buy ETFs? I'm going to go over this now and I'm going to tell you why you should buy ETFs. Now, I'm not saying that you never have to buy an individual stock. That's not what I'm saying. It would be best if you buy a combination of stocks and ETFs and do it in an intelligent way. What do I mean by that? Of course, an individual stock fluctuates much more than an ETF. Of course, by definition, an ETF is a bundle of stocks. So what you see if you pull up a price chart of the S&P 500, for simplicity, because it's the most popular, and you compare that with the price chart of an individual stock, can be Nvidia, Tesla, you will see that on a daily basis, on a weekly basis, the individual stock fluctuates around the average, which is the ETF. Now, you can definitely profit in the short term with individual stocks if you buy them right and you sell it at a proper time. But there is a risk associated with it. Now, I don't know what type of risk you can tolerate, but definitely an ETF is a safer choice. And you know that the only thing that always goes up with consistency is the S&P 500. I think the American economy is going to be the strongest economy for a very long time. And the US dollar is going to be the reserve currency of the world for a very long time. Now, I know that there are a lot of people on social media speaking about the end of the United States, the end of the dollar, that every empire sooner or later is going to fail. Is there some truth in that? Yes. But I don't think this is going to happen anytime soon. Actually, I don't think this is going to happen in the next 100 or 200 years. So listen to this. Stick to the S&P 500. Now, why do I say that ETFs are a better choice of stocks? But it's very easy. I'm going to pull up now a dividend appreciation ETF provided by Vanguard. The ticker here is VIG, and this is one of the most popular dividend appreciation ETFs. Now, at this very minute, this is January 4th, 2024, top companies are Microsoft with a 5.5%, Apple with a 4.5%, United Healthcare 3.5%, JP Morgan 3%, Exxon 2.8%, Visa 2.7%, Broadcom 2.7%, Johnson & Johnson 2.5%, Procter & Gamble 2.5%, and MasterCard about 2.4%. Those are the top 10 holdings. I think they are pretty good companies to own. Now, one share of VIG today is $169. Now, with 169 bucks that anybody can afford, you own all of those companies and much more, of course. Now, those are only the top 10 holdings. Notice something. Top two companies are in the tech sector. The third is a healthcare company. The fourth is a financial company. The number five is a energy company. Number six and number 10, Visa and MasterCard. They are everything. They're financial, they are tech companies. They really have a very powerful network effect. Number seven is a chip company. Number eight, Johnson and Johnson, which can be a pharma, but it can always be one of the consumables company. And Procter and Gamble in the consumer category. So you notice, like top 10 companies, you already covered a lot of ground with those. Those are the best companies in their field. Now, what happens here is that if one company underperforms, it's going to get kicked out of the ETF. Now, if one company does very good, their percentage in that ETF is going to grow. Those percentages that I just gave you, they change every day. And those companies, they change. Now, of course, this one is a relatively lower turnover. At this point here, it's only 12% the turnover. Now, there are ETFs with even lower turnover, 5 to 10%. Rule of thumb is that you want to stay below 15% turnover. Now this, the net expense ratio on this is 0.06%, which is really close to nothing. And actually, there is the Vanguard S&P 500 that charges you half of that. That would be only 0.03%. It's really close to nothing for owning an ETF. You really don't have anything. You don't have to do. You buy it, then you forget about it. If you bought it 10 years ago, you would have profited on the appreciation side. You would have collected the dividend because this actually pays, as of now, this pays 1.9% dividend, which is actually a little higher than the S&P 500. I think the S&P pays 1.5. And you didn't have to do anything. And you can sell it in a split second from your phone in the comfort of your bedroom. Now, if you still want to buy the individual stock because you are a fan of Apple, you're a fanatic, you bought every Apple phone and you want to buy Apple, there's nothing wrong with that. But I want you to be aware that anything can happen with an individual company. A bad news, and the stock is going to react. And it's going to react immediately. Okay? That's how the stock market works. A lot of times it's an overreaction. Like it was in the news the other day that there was a ban on the iWatch, and the market is going to react. Now, let's say that really that ban is going to hurt Apple 2%, 3% on the revenue or on the net profit. Now, whatever that is, this is just for the sake of an example. The stock price might react 10%, 15%. It's another reaction because it's so easy for people to sell their position. Like I was saying, anybody can sell any amount of stock. If you sell $1,000, if you sell 100 grand, if you sell $1 million, or if you sell a 10 million position and over, it's going to take you the same time. Have you ever contemplated that? So because of that, because the stock market is liquid, anybody can get rid of their position in a split second. And when this happens, of course, this triggers a lot of things in the market. A lot of people have stop losses. Next morning you wake up and you lost a whole bunch of money before you can even do anything. Am I clear here? Now, as opposed to that, if you bought the ETF that contains Apple stock, now, and of course, a lot of those broad market ETFs, they all have Apple as a first or second position, because Apple is a huge company. It's a very good company. And I don't have anything against Apple, or I don't have anything against any individual company. I invest in individual companies, but I do it the intelligent way. Now, I was saying if you own Apple throughout the ETF, what's going to happen is that ETF doesn't move much. And what you notice is that the percentage of Apple within the ETF, if it used to be 7%, now because of Apple price dropping, can be down to 6%. It's nearly negligible. You haven't lost anything. Now, When I say that it's okay to invest in individual stocks, but doing it the smart way, what do I mean by that? Now, of course, a good way to go about is to invest with consistency, regardless of the price. Invest your money in the stock market on a regular basis, depending on your financial situation. For example, you get paid every other Friday. Well, then you leave some money behind and you put a little bit into the stock market. And you do it with consistency. And once your position hits your exit strategy, you're going to sell it at a profit. Now, like I was saying, I would strongly recommend that you buy the S&P 500 with consistency and any variation of that. So that can be the large cap ETF, can be the dividend appreciation ETF, it can be the S&P 500 value ETF. It can always be the equal weight S&P 500 ETF. And you buy those with consistency. Now, as the market goes down, you keep doing that. Now, if the market keeps going down, that means that the individual stocks are going down more than the market. Because like I was saying, that the market is the average. So if the whole market is going down 5%, 10%, 15%, which is a lot to go down for the market, but let's say for the sake of the example, that means that the individual stock that you are interested in can be down 25, 30, 40%. In that way, you buy the individual stock at the right price. Do not overpay for stocks. Top 2 advices to be successful with individual stocks. 1, pick the right companies. And of course, by right companies, I mean companies that they've been profitable, they have a track record of growing revenues and growing profits and raising dividends, and you all know that. Use common sense. And number 2, don't overpay for it. You can do those 2 things, and you can wait for the right opportunity. Sooner or later, the opportunity presents itself, and you're gonna be ready to profit. But if you buy an individual stock, you don't know what you're doing, because by chance you came across a video on YouTube telling you to buy Tesla. I mean, you bought Tesla on that day, but how do you know if the price was right? More than likely you overpaid. Now, one of you might think to yourself, oh, okay, top 10 holdings of the S&P 500. Let's just pull up the S&P 500 right quick. And one of you guys might think, Top 10 holdings right now: Microsoft, Apple, Amazon, Nvidia, Alphabet, A share, Meta Platforms, Alphabet, C shares, Tesla, Berkshire, United Healthcare. Like I say, those are pretty good companies. Now, one of you guys might think, I don't want to pay the fee, even if it is close to nothing, that fee. I know that you're watching this video, you're smart. Now you might think to yourself, you know what? I'm going to buy those top 10 individual stocks individually. You might do it that way. But it's not the same thing. You are going to lose money by doing it that way. Why are you going to lose money? Let's just say, for the sake of the example, that you buy the top 10 individual stocks. You have 10 stocks in your portfolio. Me, on the opposite side, I own the S&P 500. Now, what happens if tomorrow something happens to Tesla? A major issue. Anything can happen. Tesla stock gets slammed. Let's just say that it goes down a lot. Then it's going to get caught in a downward spiral. And it's going to lose a lot. Now, you really only have 9 stocks. If you don't think that a stock can go to zero, you don't know history. If you pull up a price chart of a successful company, you see the price going up and up and up, and you think that it's going to be that way, you're very wrong. You'd be surprised how low the stock market can go. Have you ever heard of Enron? Have you ever heard of long-term capital management? Have you ever heard of Lehman Brothers? Have you ever heard of BlackBerry? Polaroid? Have you ever heard of the Nifty 50? I can make a case that all of those companies had stellar results. I can make a case that if you pull up the price chart from years ago, those companies looked like Apple looks today. And where are they now? Where are they? Answer the question. I'm waiting. So I hope I get my point across. In that case, now you used to have the 10 individual stocks and now you have 9. That's a huge loss. What are you going to do next? Are you going to hold on to your 9 stocks? And don't you think that sooner or later the other one is going to blow up? And now you own 8 stocks. Look, investing in individual stocks is risky. You need to really know what you're doing. You really understand the valuation of the company. You need to understand your exit strategy. You need to know how to mitigate your risk tolerance. And even the most vetted investors, they lose money with individual stocks. I remember an interview of Charlie Munger. It was a recent interview, not long ago. Peace to his soul, by the way. Great guy. It was an interview, look, not even from 2 years ago. And he was saying, look like the stock market has so many analogies with the biological world. How many species have existed on this planet? You can do your Google search. How many went extinct? Do the Google search on that. And I bet you that possibly 95% went extinct. Same thing happens to the stock market. If you pull up S&P 500 components from 60 years ago, from 40 years ago, from 20 years ago, it compare those components to today's S&P 500 companies, and you realize that he's right. He was right. And he said that against his interest. Because the company that he was vice president for, they invested in individual stocks. And he's telling you not to do so. And you are so hard-headed and stubborn to keep investing in individual stocks. And that's all you do. And when someone is telling you that you are better off with the ETF, what do you say to him? I invest like a grandpa. Now, I want to back this up with another concept of investing in a sector of the industry. Now, this also depends on your expertise. You're a banker, invest into the financial sector, XLF. That would be the ticker provided by State Street. You are a geek, a computer geek, invest in the XLK, technology sector, or the semiconductor. All of those are viable options. There is no right or wrong here. Now, of course, investing in a sector can be profitable because, like I was saying about the stock that fluctuates around the average, the sector ETF fluctuates around the S&P 500, but it doesn't fluctuate as much as an individual stock. Okay, so you can take advantage of those fluctuations. Now, of course, it all depends on the money that you have. That's where I'm going with this. If you have $100 million to invest, it's reasonable to assume that the S&P 500 fluctuates 1% on a weekly basis. Now, of course, it can fluctuate 1% on a daily basis. But let's just stay on a weekly basis. Now, if you have $100 million to invest, all you need really is a 1% fluctuation. That's gonna put $1 million in your pocket that week. Now, of course, you're gonna have to pay capital gains on that, but you see the point. Now, if you have a 10 grand to invest, a 1% fluctuation on the S&P 500, it's $100. Now, I don't know your objectives, but it's not very much. And of course, if you have $100 to invest, a 1% fluctuation gives you $1. So this is where I'm going with this, is that the more money you have, the smaller the fluctuation that you need in order to profit a large amount of money. Now, that's why you see that a lot of people with a couple of grand to invest, they want to go hit the jackpot. They have this philosophy of go big or go home. That can be very bad for the stock market, and that's why a lot of those people, they get to the industry and they leave. Now, it was a statistics saying that 75% of people, they buy and sell stocks in a very short amount of time. What I was saying is that a stock changes hands 75% within the year. So there is a lot of buying and selling, and that's when, of course, if you only have 5 grand to invest, really to make it worthwhile, I imagine that you want to profit $500. So now you're gonna have to go and find an investment that is gonna go up at 10% in value, and that's not gonna happen. And that's why so many people, they're gonna put their money into speculations. They want the quick money. They want the easy money. They go out there, they buy speculations, and by doing that, there is a huge chance that they're going to lose everything. They start losing half of their money, and they say that the stock market is rigged. They say that the stock market is a hoax, and they go away and never come back, missing out on a huge opportunity because they were never given the proper education. So now, at this point, you possibly have realized that I am a huge fan of buying large blend ETFs that include all the largest companies in multiple sectors. But let's just even say that you are a banker and you want to buy an individual company and you are a big fan of Bank of America. I would invite you to pull up the Bank of America price chart and compare it to the XLF, which is the financial ETF. And now, for all those good reasons, you might want to buy Bank of America because you work for the company, because you have a bank account with them, or because Warren Buffett owns it, and you are a fan of him. This can be very deceiving. First of all, Warren Buffett does not own the common stock, and you do. But there is nothing wrong with individual stocks. The thing is that people buy individual stocks without a stated reason. The reason why people buy Bank of America is not enough to profit from it. Like I'm looking at now at an individual chart of Bank of America over the past year, and it's flat on the year, while the XLF is up at 10%. Within 2 years, Bank of America is actually down, and the XLF is up about, it's close to be flat. Let's compare that with the broad market ETF. The SPY is the broad market ETF. Compare that over 2 years, you were better off buying the broad market. Let's say 3-year chart. On the 3-year chart, you were better off buying again the broad market, and the XLF. Bank of America is actually down on the 3-year chart. Let's just say on the 6 months is a little up. On the 3 months is up. On the 5-year chart, you have the S&P 500 is up about 75%. On the 5-year chart, the XLF is up about 50. Bank of America, I would say it is up about 30%. I don't know. I feel like I want to wrap up right now. I hope this has been helpful to you. I don't know what individual stocks are you gonna shop for, but I'm gonna tell you what I'm gonna do. I'm gonna add to my pre-existing position of the S&P 500. Happy investing, everybody.